Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate filings. Today we're diving into Blink Charging's latest report, and let's just say there's a new warrant out for their future growth. So Blink Charging, the company focused on electric vehicle charging stations, is reporting on an important deal they've entered into. It's all about a merger with a company called Envoy Technologies. Now, usually when companies merge, there's a lot of money changing hands up front, but in this case, Blink is settling up with some of Envoy's former owners using a mix of stock and warrants. Here's the gist of it. Back in August of 2025, Blink Charging made an amendment to a merger agreement. This amendment lays out how they're going to fully settle the remaining payment for the Envoy Technologies deal. They're going to do this in two main ways. First, they're issuing 10 million points. First, they're issuing 10 million $10 million worth of Blink's own common stock. Specifically, they issued almost 9.7 million shares of their common stock. Think of it like paying with IOUs, but instead of debt, it's ownership in Blink Charging. They determined the share price for this by looking at the average stock price over 25 days before they issued them. This is a pretty standard way to make sure the value is fair and not just based on a single day's stock price. The second part of the deal involves warrants. Blink is issuing warrants valued at $11 million. Now, what are warrants? Think of them as options to buy stock in the future, usually at a set price. These particular warrants are divided into three groups, and they'll only become active or vest if Blink's stock price hits certain targets. This means the former owners of Envoy Technologies are betting on Blink's future success. If Blink's stock price goes up, these warrants become more valuable. Then on August 26th, Blink officially signed a warrant agreement with these former Envoy owners. This agreement locks in the details for those warrants. They can buy up to about 3.9 million shares of Blink stock for a very small price, just 1 cent per share. Now, here's something interesting for investors. Both the shares they just issued and the shares that might be issued from the warrants have what they call a leak-out period. This is a 120-day period, starting when the shares become available. During this time, the former owners can only sell a limited amount of their Blink shares each day, 2%, and a total of 20% each month. This is to prevent a flood of shares hitting the market all at once, which could drive down the stock price. It's a way to manage the impact on Blink stock. Also, these former owners have been given registration rights, meaning Blink has to help them register these shares so they can be legally resold. Blink is committed to filing a registration statement with the Securities and Exchange Commission within 30 days and getting it approved quickly. This is pretty standard for these types of deals. Let's dig a bit deeper into these warrants. They're good for 20 months, expiring 20 months from August 19, 2025. The bargain price of 1 cent per share for these warrants is a strong indicator that these shares are being valued much higher today. The terms also allow for adjustments if Blink does things like stock issued for employee compensation or strategic deals. Now for the exciting part, the vesting conditions for these warrants. To unlock the first chunk of shares, around 1.47 million, Blink stock needs to close at 1.7 million. Blink stock needs to close at $1.07 straight trading days. This is a clear signal that Blink wants to incentivize its own management and the former owners to boost the stock price. Then another block of about 1.119 million shares will vest if the stock hits $2.10 for 7 consecutive days. And finally, the largest chunk, about 1.24 million shares, will vest and become exercisable if the stock price reaches $4.85 for 7 consecutive trading days. Blink's management will be the final judge on whether these price targets are met based on official trading data. This structure directly ties the value these former owners receive to the performance of Blink stock. Remember that leak out period? It's pretty strict. It goes for 120 days and they can't sell more than 2% of their total potential shares on any single day and not more than 20% in any given month. The part that's interesting is that any unused portion of that monthly limit can't be carried over, so they really have to pace their selling. However, in the last 30 days of that period, they can sell up to 5% of their shares daily. So within that 20% monthly cap, and all sales have to be through the main stock exchange where Blink is listed. Here's a crucial point for anyone holding these warrants. If Blink Charging undergoes a change of control, meaning if they get bought out or merge in a big way, any unvested portion of these warrants automatically becomes fully vested and ready to be exercised. This means the former owners would get their shares and then participate in that buyout deal on the same terms as other Blink shareholders. If they don't exercise before a buyout, the warrants still remain active, unless the buyout deal terms say otherwise. Similarly, if a fundamental transaction happens, which is basically a major change in the company's structure. The warrants will either be taken over by the new company or have their terms adjusted to reflect the new reality. The holders would then get whatever they would have received in that transaction had they already exercised their warrants. Now, all these shares and warrants that were issued to the former Envoy owners were done so without being registered with the SEC. This is allowed under a specific exemption in the law section 4M2 of the Securities Act, which is for private sales that don't involve public offerings. This is pretty typical for mergers and acquisitions. And just to wrap up the official details, the actual warrant agreement is filed as Exhibit 4.1 to this report. This is the formal document that lays out all the nitty-gritty terms and conditions of these warrants. So what does all this mean for Blink Charging? On the surface, this filing shows Blink is diligently working to finalize its acquisition of Envoy Technologies. The structure of issuing stock and performance-based warrants demonstrates a clear strategy to align the interests of the former Envoy owners with the long-term success of Blink. They're essentially saying, we'll give you more value if we hit these growth milestones. The tiered vesting schedule with targets at $1.7 Olivine Bollard's 70 cents of with targets at $1.7 and $2,000 with targets at 1.70 cents, 2 times again all that interest of the former Envoy owners with the long-term success of Blink. They're essentially saying, we'll give you more value if we hit these growth milestones. The tiered vesting schedule with targets at 1.70, 2.10 and 4.85 provides clear roadmaps for what success looks like. However, the success of this deal hinges entirely on Blink's stock performance. If Blink's stock struggles to break above those 4.85 marks, the former Envoy owners might not receive the full intended value of their warrants, and that could signal underlying issues with Blink's business or market perception. The leak-out restrictions are a smart move to prevent immediate selling pressure, but they also highlight a potential need for liquidity among those receiving the shares. A key risk for Blink is whether they can actually achieve the growth needed to satisfy those warrant vesting conditions. The electric vehicle charging market is competitive, and while Blink is a significant player, they face challenges from larger established companies and new entrants. Their ability to execute their business plan, expand their network, and generate consistent revenue will be critical. In conclusion, Blink Charging is making it explicit that their future growth is tied to tangible stock price increases. The deal is structured to reward past contributions and incentivize future performance from those who were instrumental in Envoy Technologies. It's a calculated risk, and investors will be watching closely to see if Blink can deliver on these ambitious targets. The next few months, especially as we approach those potential stock price milestones, will be telling. Alright, that's our breakdown of Blink Charging's latest filing. What's your take on these warrants and growth targets? Do you think Blink can hit those price points? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate America. Don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching. See you next time.